notice to let you know that I'm recording. So all you have to do is click got it, and we can continue. I will go ahead and just mute everybody, but again, feel free to unmute yourself if you need to ask something. So thank you all for being here. This is our second webinar in our Unlocking the Secrets to a Real Estate Wealth series. Tonight's topic is budgeting. Last week, we talked a lot about kind of the basics and what some financing will look like. Now we're going to really dive deep into the budgeting of investment properties. And Rob Garrison is our host tonight and our educator. For those of you that don't know Rob, he is the co-owner of Michigan Mortgage, and he's a loan officer here. He's been in the business for more than 26 years. So he always tells us stories when he used to carry his backpack, phone around, and his pager and all those things that I've never even seen before. But he's been doing this a really long time. He's helped hundreds of people build financial wealth through real estate. And, I think he truly goes above and beyond to serve not only his clients, but also his community. So tonight, Rob will demonstrate the art of effective budgeting, tailored specifically for your real estate needs, whether it's purchasing investment properties or managing your budget for your primary residence, and ensuring that you have a secure and balanced financial approach, because that truly is key. So let's get started. Rob, I will make you the host so you can then share your screen.
All right. Well, thanks everyone. Yeah, so this is being recorded. We had about 30 people sign up, so hopefully if you are listening to this later, hopefully the recording is all clear and everything for everyone. So thanks for joining us, those that are live. We will have a Q&A at the end. I should be able to get through this PowerPoint in maybe 20 minutes, so it's not long, but we'll have some time to just chat about some different stuff. So last week, Rob Wagenmaker did a really good job of just kind of giving a broad outline of some of the things regarding real estate investing. Today, I'm going to take a little bit deeper dive into just the financial piece of it. So let me just share my screen, and we will jump right into it. Oop. Hold please. Somehow I got me to the very end. Let's start that again. All right. Okay, so budgeting, what you guys need to know. So what we're going to cover today, we're going to cover just basically reasons to invest in real estate, why you need a budget. So I've been doing budgeting with my clients for years, and we're actually going to look at a specific budget. If you guys don't have just a household budget, let me know. You can just email or text me, let me know, and I can get that over to you, and you can fill it out in probably 10 minutes. So I'll walk you through that quickly tonight. So we'll also cover how much money you would need to invest in real estate, the traps and pitfalls that you can sometimes expect, and how to evaluate the return on investment. And I got some really cool data pieces to show you there. So let's just get right into it. Let me get that down. So first of all, I just want to cover, and Rob did cover this last week a little bit, but just as a reminder, some of the reasons to invest in real estate. And Courtney had indicated that what I'm going to cover regarding the budget has to do with household, like for your primary residence, but mainly today I'm going to be talking about real estate investing, budgeting for like investing in like rental properties and things like that. But when we go over the budget, this obviously could also be used to determine like your disposable income for purchase of a primary residence as well. So just with regard to, hold on one second, guys. I don't know why, but I just blanked out here on the screen. Okay. All right. So tax advantages. Oh my my gosh, you've got to be kidding me. All right. So tax advantages, you get to deduct the expenses that you have for real estate. You also are able to depreciate the property over 27 years on an investment property. And you can actually defer the capital gain. So if you buy a like property, and Rob covered this last week as well, but if you buy a like property after you sell one, the capital gains can be deferred, and you can continuously do that. Can continue to defer the capital gains. So there's definitely some tax advantages for that. There's also appreciation. Now, appreciation doesn't happen every year on real estate, but there's only been, I think, 2 years over the last maybe 25 years where it actually didn't appreciate in some degree. And you'll see that you can usually expect about a 3% appreciation. And we'll show you just how those numbers work and what that can do for you. Um, the other advantage is you can actually cash flow through investment property. The big thing is just leverage. So remember, you only have to come up with a certain portion of the house that you're buying because you can finance it, right? So you only have to come up with a down payment portion of it, yet the entire asset appreciates. And I'm going to show you actually what that does for you over time. So that's a really big thing that people kind of lose track of, is it's not all of their money that they're using to actually get all of the appreciation. So that's really, really key when you're investing in real estate and why it's such a good investment. The other thing is just amortization. As you pay down the mortgage, you build equity. It's kind of, think of it just like a forced savings plan. And that actually is a real thing too. And I'll show you that when we delve into the numbers. And just strictly portfolio diversification is just a good thing to have in your portfolio is real estate. And also, it's an inflation hedge. So right now you can kind of see this where inflation is high. And when inflation is high or the GDP is high, there's actually a higher demand for real estate as well. And you're seeing that right now. There's never been a higher demand for real estate than right now. And we've got really high inflation. So it is a way to hedge against inflation. So let's just delve into why is the budgeting crucial. I'll just quickly go through this. You kind of need to know what things are going to cost and what you can expect for a return on investment. Just risk management, you need to know what the risks are and how you can weather storms when those comes up. Maximizing your returns, identify the areas where you can cut costs and maximize revenue. And just really to meet your financial goals, whether your aim is to build wealth, generate passive income, or secure your retirement, budgeting helps you align your investment strategies with these objectives. So pretty basic things, like it makes sense that you need to know the numbers. So and we'll show you how to do that. So let's just delve into the actual budget itself, just to, I'll kind of just quickly go through this and show you what I do with clients. So this is just a super basic budget, and I take just the monthly income. And remember, you have to use your take-home pay, right? Not your gross, your take-home pay, because when you're doing a budget, you have to figure out leftover at the end of the month. So in this particular example, I took someone that has a take-home pay of $4,500 and a spouse with a take-home pay of $3,000. So the take-home was $7,500. And I just went through and just tried to put in living expenses. And we're not going to go through each one of these things, but for most of them, I just used the national average on them of costs of, utility bills and things like that. And in this particular situation, they had about $3,000 of monthly living expenses. Over here, you have to put in if you have a current mortgage. And I'm going to assume that this is someone that's looking at buying real estate, but buying real estate for investing, but they actually already own a home. So they have a mortgage, they had some student loans, auto loans, and then they had a few little credit cards. So in this particular situation, they had take-home pay of $7,500, living expenses of about $3,000, secured and unsecured debt of another $2,800. So at the end of the day, they have about $1,600 a month to be able to spend on purchasing a property. So it's important to know, even if you're cash flowing on your real estate investment, it's important to know that you have some money left over, because even if they cash flow, they may not cash flow every single month because of vacancies, because of repairs and expenses and things like that we'll cover here in just a second. So let's go back to this and go to the next slide. All right. What are you going to need down for investment property? So this is something that you definitely need to know. So on a if you're purchasing a single family home as an investment property, you can get away with putting as little as 15% down. But what happens is, if you're only putting 15% down, you will have mortgage insurance, and the interest rate will be significantly higher than if you're putting 20 or 25% down. If you're buying some 2 to 4 unit, you're going to have at least 25% down. What I always tell people is that you're going to probably need to plan on about 20% down. But note that if you're putting anything less than 25, you will start getting hit with what they call points and fees. Basically, it's just a higher cost to get the loan. So just plan on at least 20%. It's best if you can put 25% down. So I just use somebody that's trying to buy a $200,000 property, which is not even easy to find anymore. But at a $200,000 property, you're going to still need somewhere in the neighborhood of $50,000 to $51,000, because not only do you need the down payment, you need the closing costs, and you need to set up escrows. You don't have to put the escrow in a payment, but if you don't put it in your payment, you're going to have it somewhere anyway. So you need to plan to have that, that amount of money down. Again, if you don't set up an escrow, you won't need to put quite as much money down, because they're not taking all of that money and putting it into an escrow account for you. But just for our purposes, you should know that you're going to need that about $50,000 to buy a $200,000 property. Okay. All right. So what can you expect for payments? So this is all over the board, and there's no hard and fast rules, but generally speaking, if say interest rates are say 6.5%, you can expect to have a rate of about 7.5% ish on an investment property. However, they also carry points with them. You can't it's very rare to be actually able to find a rate that doesn't carry points with it on an investment property. And if you're putting less than 25% down, it's even more rare to be able to find that. So just note that whatever you put down, it's going to probably have some points associated with that. Also remember that the taxes on an investment property are higher than on your primary in Michigan, and that the insurance is also going to be higher. So how much you're going to need, again, it depends a little bit, but roughly on a $200,000 loan, your payment's going to be roughly $1,500. I should probably go like this. Okay, so if you guys want to be able to run your own payments, you can scan that QR code, and it's going to bring you to our app that has a calculator on it. So if you just put that, just scan that in right now, and you can play with that. Just note that the settings that are in there are set more in line with a primary residence. So you should probably increase whatever rate is in there, and those rates don't move daily, but we change them as the market changes, and we change them, I think, once a week or something like that. So just note that you should increase about 1% if you're doing an investment property. There's no calculation for that for you guys in there, but just know just to do that. Okay. Here's kind of what it looks like. And on the right-hand side, you can just see that the sale price I put in here is 200,000. The loan amount is and I just put 20% down, 160. shows you the principal interest, estimated taxes and insurance. And because they had 20% down, there is no mortgage insurance in this scenario. And then you can see the total payment is up here. And it just sort of breaks it down for you. So about $1,500 a month for $200,000 property. And again, you guys can play with that calculator that's in there. All right. Let's talk about some of the pitfalls, and then we'll do a return on investment on a particular property. So remember, and this is one of the things that people just don't expect or don't plan for is vacancies. I tend to like to use around 80% vacancy, 80%. So 20% of the time it might not be rented. Now, if you have a really good renter in there, great. That, you won't have that, but just expect and plan for use some number for vacancies. Also plan for renters not paying on time. So the other thing that you need to consider is, while there is appreciation in real estate over time, it doesn't actually happen every year, and it might not happen on your time frame. So if you have to sell within a certain period of time and you don't have the appreciation you want, you may not get the gains that you want. So just plan for that. Also, there's damage that happens with real estate, and there's maintenance and repairs. So let's just look at whether or not, when you're looking at a property, what do you look at to determine whether it's a good deal? I'm going to show you something that I use that I'm sure that there's a bunch of different things online that you can access. This is a paid version of an app that I use that I'll show you here in just a minute. But before we get into that, let's just look at what are the things that you want to evaluate financially when you're looking at purchasing real estate for investment. So first of all, does it cash flow? So the very, very basic thing is the rent, how much you're getting for rent, or how much could you get for rent, minus vacancies and expenses. And like I said, I like to use a number around 85% for vacancies and expenses and things like that. So if your rent is 2,000, if you rent, you're getting $2,000, and we already determined that the mortgage is $1,500. It sounds great, except that there are vacancies and there are repairs and there are other things. And so if we use 85% of the rental, then you're right around $1,700. So you are still cash flowing, but not maybe as much as you might think you're going to. Okay. So the other thing you want to determine is, what is the appreciation for your particular area that you're looking at? And there's a site that I have access to because we pay for it. We can help you guys with that. If you have a particular property, we can get this evaluated for you. But just use around 3% you can expect for appreciation. It's not exact. It varies per year. It varies by area a little bit, but that's kind of a general rule for you. And then what is the overall return on investment? So let's just look at something that I put together. And it's a little more detailed. I'm not going to run through all of the data points that I put in here, but I'll just show you what it came up with. I'll just tell you, I used the same thing that we've been using, a $200,000 property. And I put in, I did an analysis for a 5-year period. Like, what is the return on 5 years if I could get $2,000 a month for rent? Okay. So remember, you don't get the 2,000 because there's expenses and things like that. So in this particular situation, we got it $1,700 and the expenses were $1,586. Remember, that was our mortgage, right? And then the total cash flow is $174 per month. So after 5 years, we have a total of $20,000 gain. But remember, we only had to put in 20%, right? So we put in $40,000, and in 5 years, we returned $20,000. So that's a 42.9% cumulative cash on cash return. So that, remember, I was talking about the value of buying real estate. One of the big values is you don't have to put in $200,000 to make $20,000. You only had to put in $40,000 to make $20,000 because you're leveraging the money. You are borrowing the money. So that's one of the big things that help people build wealth in real estate is the fact that they can borrow the money to do it. Even at a and then again, this I used I think I used 7.9% for an interest rate on this thing. So even at 7.9% interest, this still actually made money over time. So let's look at why it made money. So it made money because number one, it cash flowed, but also we had appreciation gain over that time period. So and there was just a forecasted appreciation of 2.54% per year. And after 5 years, it's now worth $226,000, just using 2.54%. Remember, it accrues yearly on year over year at that rate. So it's what's the word I'm looking for? Yeah, I can't think of the word. Anyway, so basically it's interest is accruing. So after the first year, it accrues 2.5, and then so it's worth a little bit more, and then it accrues again and accrues again and accrues again. So, and then the other thing that we had is just amortization gain. Because you were paying down the mortgage during that time period, you now only owe $152,000 rather than the $160,000 because you've been paying on it for the last 5 years. So you got the rental income and the appreciation. So between those two things, you have $142,000 and your expenses were only $108,000. So the profit is $34,200 on a $40,000 investment. So the return on the investment is actually 85% over that 5-year period, or 13% per year. Again, that's because of these other things, not just the cash flow, but the appreciation and amortization gain that you're getting. So you can see that it's even with really small conservative numbers, if you stay at this and you have just a small appreciation amount, you can actually build wealth over time. All right, so I'm going to stop sharing that and we can open that up to questions.
Yeah, I have a quick question on that one. So is that were we looking at like a hypothetical 30-year loan there?
Yeah.
Okay, got it. So
Yeah.
I'm curious because my understanding is that over the course of 30 years, you're paying largely interest on the front end of that, whereas you're paying principal on the back end. And I suppose my question is, are you really benefiting from the appreciation of your property, in that kind of first 5, 10 years if you really don't have much equity in the property yet? That makes sense.
Yeah, that graph accounts for that. So it's still appreciating, even though you're paying interest on that, especially on remember what this is showing is a property that's actually cash flowing for you. So it's not cash flowing a lot, but it's taken into consideration your principal and interest that you're paying. You still cash flowing $174 a month in our example.
Okay,
So and you're also appreciating about 3% per year. So, and that was just a 5-year snapshot.
sure. Yeah, no, I was looking for clarification. So if it did appreciate 26 grand over that first 5 years, is
Yeah.
that 26 grand, I suppose, your equity that's not held by
Yeah.
the lender?
No,
No?
that's your equity. So
Okay.
think of it this way: at the end, if all the numbers are accurate, at the end of 5 years, you're going to sell that property for $226,000. Now you only owe 100 and whatever that number was,
Mhm.
151 because you paid it down. and you had the cash flow during that time period. So if you just go back to this graph accounts for all of that. So this was, yeah, you 7.9% at 8.1. So it's accounting for that at a 2.54% increase. You still, the appreciation is still yours. The only time the appreciation isn't yours is if they foreclosed on you, you didn't make the payments and they get the property. But you own that property, even though you only put in, 20% or whatever you put down. That's your appreciation. Yeah, and you paid 8 grand down during the time that you were still cash flowing that thing. So you can, the other piece to understand is that even if you have a property that might not cash flow or just barely cash flows, you can still make good money on that again with appreciation. And appreciation and amortization, actually. And again, because remember, you're not putting the entire amount of money down on this thing. You're only putting a portion of it. Someone else is putting the other portion of it, which is the bank. And so that's again, that's why I like to see these things cash flow at least a little bit for people, just so that so they're just not going backwards and they don't panic and try to get rid of a property too early. You kind of got to let the appreciation happen. So, and Ryan, it's a good question because there's graphs and things that will show you, this is a pretty basic graph, but there are graphs that will show you like over time how much more you gain and how quickly you gain it because of the interest that you're paying.
Got it. Yeah, thanks for clarifying that.
Yeah. All right. Anybody else? If anybody needs that budget, just text Courtney or text me. Courtney, do they have an email that they can ask for that?
Yes, tomorrow morning I will send out a follow-up email that has our contact information in it, as well as a recording to today's webinar, so they can review it, and then obviously reach out and contact us and ask questions if they need assistance.
Cool. All
Yeah, you
right. Well,
guys. Yeah, any more questions? You're welcome to unmute yourself or use the chat box, whichever you prefer. And just a reminder, next week, we will conclude our series. We're talking all about credit and different strategies to build credit, because in today's world, that's kind of a very large end all be all that we all face, whether we're buying primary residence or investment properties. That is certainly key and will determine how much you end up having to pay for that property in rates. So that's how we'll conclude. So if you haven't registered for that, you can do that on our Facebook page, or we'll send out some emails. But if there are no more questions, we can wrap this up and say goodnight.
all right. Thanks, guys.
All right. Thank you all. Have a great night.
Thank you very much.